Okay, good afternoon. Today is September 8th, Friday, 2023. This is your weekly take on the market. It is 1:01 p.m. The market just closed. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I know I mention it every time, but it's needed. I'm not licensed. I can't tell you what to buy, what to sell, how many stocks to own, what to do on earnings, what percentage of stock you should own. Uh, these webinars are vetted for compliance, so I am able to speak more freely on these webinars. But I am not licensed, so nothing should be construed as a buy, sell, or hold. Nobody at IBD is licensed, at least nobody that I'm aware of. All right, so we'll do market thoughts. We'll look at the industry groups. I haven't looked at those in a couple of weeks. Um, Stocks to watch, got a few of those, and then the quote of the week. So I was out last week with the when we do the monthly stay in step on Thursday. I usually take that Friday off unless something drastic were to happen. But back at it, so a lot of stuff to go over. Um, Mega cap tech stocks, indexed year to date return. It's a little fuzzy. I apologize. From Twitter, cut and paste job. But Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia. At this point, now this might be a couple of weeks old, so bear with me. But the idea is all that's important here. 54%. The S&P was up 15% at that point, and the remaining 493 companies were up 4%. So it's been a very strange year. The breadth hasn't been all that great, but maybe you just need to own these stocks. And Nvidia has been very ownable. Tesla, I haven't owned it, but I know probably a number of you have. Very ownable. Microsoft for sure. Meta a little bit harder, but there was a flat base. Amazon, and of course Apple. This is probably Apple's kind of been under a spot of bother last week or so, so this is probably not that exact, but the idea is this is what's happened this year. Now, today, as we sit here and we'll go over it, like I mentioned with Apple, Nvidia feels a little tired. Tesla, it's okay. It's not terrible. I'm not in any hurry to run out and short it, but it doesn't feel like a long either. Um, Meta's holding up really well. Microsoft's holding up better than the most. Apple, Amazon, and Google. So it's a mixed bag. And the indexes have come off their highs a little bit. We'll pull those. We'll pull those real soon here, but not that much. It's a very interesting time. I feel like we're in a really transitional period here. You're getting into that seasonal period that everybody's talking about, which makes me nervous because everybody's talking about how seasonally this is September's bad and the rest of the year is good. But that's normally how it plays out. So we're in an interesting time of year right here, September 8th, as we sit here. Speaking of seasonality, here is a chart from Macrobond. S&P is at negative returns in the month of September. 55% of the time. Very interesting. So all other months are mostly above 50% as far as positive. These are those blue histograms are negative returns on a month. So September's the highest by far. Looks like February is second round. What's that around? Maybe 46. But look at December. Very rarely is December negative, and even October and November are 40-40. So this is that seasonality that we're in. I think the returns down below those histograms they're monthly returns for 2023. So January was gangbusters. Um, um, February was slightly negative. Gosh, the years go by, man. It's just like I don't remember February being all that bad or what. But March, April, May, June was really strong, and August was slightly negative. So that seasonality is coming up. I really like this chart. Now there's some problems with this chart, to be honest with you, because I'm not certain how they know. Like, Richard Dennis, I think he was trading his own PA, his own personal account. Is that an audited 120% per year over 19 years? But maybe it's, even if it's anything close to that, that's incredible. Michael Marcus, and even for like William O'Neill, they have him at 40% for 25 years, but it's family owned. Not, they're not going to disclose that. I feel like they've mentioned his returns publicly at events and stuff, and I've always heard like mid 30s over the number of years that he traded is incredible, though. Mid 30s over that many trading years. But this is, I think the thing I like about this is if you go down the food chain here, like Warren Buffett, 23%, the greatest investor ever, compounded annual returns of 23%. Jerry Parker, who's a trend follower, 22. Tom Klaugus, kind of a value guy. He was in hedge fund market wizards, 21. Seth Klarman, who everybody raves about, people pay thousands of dollars for his used book, 16.5%. So I think the thing here is, now it's not apples to apples, because the amount of money I'm running for myself versus these guys is pales in comparison. But like Stanley Druckenmiller, 37% with big money. So these are very impressive numbers. But 22, 23, 24, 19, 18, these are very impressive numbers when you're running big money. So from a personal standpoint, I think about this as like a target to, I ought to be able to do this if I'm running my own money, because I'm a PT boat and these guys are battleships, and I can move around and protect a little bit faster. So it gives you kind of a target. But the main thing is like, if you make 24, 25% a year for a number of years, you're one of the great investors out there. And everybody's so enamored with these anomalies, these outliers, like so-and-so made 500% one year and so-and-so made 700% the next year. And it's really good. I've had some, the first year I ever traded, I made, 22 times my money, but starting from a small base. So it's much easier it's not easy, but it's much easier, obviously, to turn 10,000 into a $250,000 than it is to turn 10 million into 250 million. It's not even in the same ballpark. So 20, 25%, these are really good returns. If you're doing that, you're doing really well. And you look at Warren Buffett, you do that for a number of years over and over and over, the compounding will add up big time. Okay, so let's jump into the indexes before I go to the industry groups. Make sure I resume the share. Here's the NASDAQ. And so backtrack here, NASDAQ makes a peak on 719. S&P on 719. Oops, I hate when it does that. Was right there. Okay. S&P makes a higher high on 727. Kind of a nasty day. Maybe there was some kind of CPI number or something. I don't remember exactly why I did that. It's probably news related. Market probably tried to open higher and reversed. And NASDAQ on that day couldn't make a new high. So you had a negative divergence, which easy, in hindsight, I get it, but it had me nervous. It wasn't a great negative divergence. It's a very small window here, but a negative divergence, and you've led to this little sell-off here of, what is that? Is that about 5 or 6%? 8 and change. You've rallied up, and now you're building this, potential handle. And so I think the market's in like a really tricky spot right here. It could bust either way. So you've rallied back up above the moving average, get everybody back in, back to new lows. That is a possibility. Or this rounds out, and I know it's an index, it's not exactly right, but then you get some kind of buy point here later on. Ideally, it would be a little more sideways. A cup with handle on the index isn't the greatest signal, but I have seen Bill draw that at seminars. I remember I can't remember what year it was, where they drew a cup with handle on the IBD mutual fund index in the newspaper. I got the hard copy of the newspaper and saw that they had drawn a cup with handle on that index and thought, wow, that was pretty, and it turned out to be a pretty bullish signal. So the jury's still out. I don't know. There's something about the market here that I can't put my finger on. On IB Live, I talked about my friend who said he always used to say the market was either on the give or the market's on the take. And when it's on the give, you want to be uber aggressive. And when it's on the take, you want to be uber neutral, uber conservative. And I've never seen anybody personally who was better at that than my friend. He could be like Jim Ropel, full margin, pedal to metal, buying everything, concentration. And when the market was on the give, like the 90s, and then when the market is on the take, he's like Warren Buffett, just sitting there doing nothing, watching, sitting in cash or mostly cash, and just patient, waiting for his time. I feel like the market is on the take here. And so maybe this is an old saying, but when something's on the take, right? What's the market doing? It's taking your money. So you go in, you think you have a setup, and then it takes your money, you get stopped out. You go in, you think you have a rally day on the market, and it closes on the lows, so you reduce exposure. And you just keep doing this over and over, and pretty soon you're 8 or 9% off your highs, wondering what happened. I don't have a ton of conviction that that's the case here, but I am leaning that way. So I'm lightly invested, very, very lightly invested. I have some shorts. I have a few longs. I don't own anything that would be heavily influenced by the indexes. So I don't own NVIDIA any longer. I don't own what else did I own that would have been? I don't know. I don't own VRT any longer. I don't know if that would be influenced by the indexes, but they just feel tired to me, and we'll go over those later. So now we've got a relative strength line here that peaked there. So if this were to happen, I really would love to see that RS line jump above that high so that you have a lower high number wise, but relative strength wise, it's showing you that the NASDAQ is leading, and those are the best environments for us, NASDAQ leading. S&P looks very similar, right? There's really not much difference to it. The Dow, let me just pull up the diamond. Yeah, sort of the same. The Russell and stuff like that is not acting all that well, but it's strange the Russell never seems to act all that well. And then emerging markets, EMXC, just a big nothing burger. If you bought this in 2018, you're pretty much the same spot. If you bought EM, or is it EEM? So since 2007, I don't know what the yield is on something like this. Is there a yield? 2.3%. Let's forget about the yield. But since 2006, 2007, you've gone nowhere. And so I know it's emerging markets, and the US has it's just an incredible place to be invested. And there's reasons for that, obviously. But emerging markets just have not worked for years and years and years. I just find that, I don't know if disconcerting is the right word, but just strange. Like there's just no period where they do well. China has interesting to me because it has a lot of bad news, like cover of Economist bad news. And I think I've mentioned this before, not making new lows. Is it CAF, which is the It's not all that great. It's very close. So jury's still out. I don't own anything China related. I did try Li Auto here and got stopped the very next day. I like Li because of the big earnings and sales. And so I thought it was worth a shot, but it didn't work. It tried to bounce and next day it was down. And that was that for me. Okay, so I think IBD has market under pressure with the percentage at 20 to 40%. The key is that percentage number. That's going to be much more dynamic in the future. I think probably will go away, maybe with the so black and white market in an uptrend, market in a correction. It's never that simple anymore. The market has evolved and it's just so much different than it used to be. The bear market that we had was really, really bad for most stocks. So like this bear market is like, if that was the index, it'd be like a border on, top 3 or 4 worst bear markets ever. So the NASDAQ and the S&P didn't really portray how bad the market was in late 2021, 2022. It just, I can name it. I mean, look at this: Twilio, Sea Limited. These are all monthly. Shopify has come back a little bit, but you see, these are 2000 like declines, and so the indexes did a much better job of hiding that than the individual stocks. Individual stocks did really poorly. So it's just the dynamics of the market are a little different. So the main thing is I think the percentage that they gives you a better read. It gives them more flexibility. If they can go from, I don't know if they have buckets like 0 to 20, 20 to 40, 40 to 60, 60 to 80, 80 to 100, but now they've got 5 buckets of exposure versus 3, uptrend, downtrend, or somewhere in the middle, right? So gives them more ways to convey what they're seeing in the market. So use that percentage a little bit if you're looking at that, if that's part of your routine. Okay, industry groups. Computer hardware, why is that still number 1? Well, SMCI, okay? And maybe this is a good spot for a lesson. Now, SMCI actually is holding up okay, considering this bad break. It is down 21% off the high. And the relative strength is 99. And so you might say, well, how can that be a 99? I mean, it's 20% off the high. Imagine it never made that peak. So the relative strength is a trailing 12 months, not perfect. There is a weighting in the first 3 months and the first 6 months that we give them more weighting. But imagine at last 12, if I said weeks, I apologize, months, 12 months. So let's go back roughly 12 months. And imagine SMCI went from 80 to 280. Pretend it didn't do that. So it went from 80 to 280. Where do you think that would fall in the bucket of relative strength versus all other stocks in our database? 99, right? Obviously, that's what's happening. So that's why the relative strength line is important, because it will better signal versus the RS rating. The RS rating is a stock selection criteria. It's not a stock timing tool. You would never want to say, I won't buy that. The RS is 99. It's too high. I would never do that. And vice versa. I would never not sell something that I felt needed to be sell. Oh, look how strong it is. The RS is 99. When I'm looking for stocks, looking for ideas, I want high relative strength stocks. So it just allows me to start with a smaller universe of potential ideas. If I'm looking at 90 or better, instead of 9,500 stocks and or ETFs, I'm looking at 950. And then I'm, trying to use my own, eye to narrow that down. So that's why the group is still so strong. Supermicro and Dell Computer is kind of, wow, it's really been a great stock. Dell Computer has as well, kind of behind the scenes. Commercial soft services document, 5 stocks I can't think of who would be the leader in here. So let's do that. So it's Iron Mountain, Cimpress, Pitney Bowes. Gosh, pass. I guess Iron Mountain must be doing really well. Let's pull up Iron Mountain. Looks fine, relative strength 88. So not a great group, pass. Computer software, desktop, building, AC and heating products. There's been some really good stocks in here that I think there was one that I didn't buy because I felt like it was a little small and then was sorry that I didn't buy it. Was it LMB? Wow. If it wasn't LMB, it should have been. I don't feel like it was LMB, but anyways, what a great group. And it sort of goes to show you that they don't always have to be fancy, the stocks. There's no, you don't get any bonus points for creativity. Like it's not gymnastics. Good companies, earnings and sales, good businesses. A lot of these are moving because they're so small. Look at the market cap and the float. It doesn't take much to move those. Building construction products, oil and gas machinery equipment. So that's moved up the food chain a little bit. So Baker Hughes has looked good. It's been tight, but it looks okay. Insurance life, not a group that I would buy, but it tells a story, right? If you start to see these types of groups showing up, computer software database, beverages, non-alcoholic. Now, one of the great stocks that I haven't mentioned before, but I'll talk about, say, Celsius, CELH, is in that group, and Monster, of course. So that's not really a defensive group, beverages, non-alcoholic. So I wouldn't read too much into that. Oil and gas, internet content, et cetera, et cetera. So the groups are pretty eclectic, and it has been all year. You really could have been, you didn't have to own 7 stocks. There were some groups and some different types of stocks: oil and gas, beverages, building maintenance, building residential, commercial, home builders, plumbing and heating companies, and so on and so forth. All right, let's jump into the stocks. So let's start with the FANG one, since I kind of started. Let's look at Apple. So Apple gapped down on the earnings, very pedestrian, and their earnings have been very pedestrian for a long time. Look at the deceleration in earnings and sales. It's everyone say Apple's a great company. Yeah, it's a great company, but you own the stock, and it's gonna be hard to move the stock based on the size of the company, the economies of scale, and the deceleration in the earnings and sales that it's incurred. So this is not acting on the well. I have full disclosure, I am short Apple. I shorted it this day on the earnings. And it's more like a kind of a bellwether, a barometer, a buoy. One thing about I heard this girl, she works at Tudor Jones on a podcast. I apologize, I can't remember which podcast it was. I'll have to find it. Maybe I'll use one of her quotes. And she worked at Tudor Jones, or does work at Paul Tudor Jones money management firm for 20, 30 years. And she had a lot of thoughts about shorting, how it allows them to stay long. That's kind of what the big money uses shorting for. So they use it as kind of a balance, and they can press their longs if they really want, because they have these shorts, and maybe it allows them to stay in their shorts. And imagine you were short something like Shopify or Twilio or C Limited, and the stock you really loved, C Limited went down 80%, but your stock only went down 30%, and you didn't have to worry about selling it. And you could then take C Limited off and look for another name. So that's kind of how they use shorting, which I think is probably from the big money standpoint. I use it more speculating, honestly, but I am thinking about that more in helping me to stay with names a little bit longer. So because I'm always, every little wiggle in the market seems to to get me out. So maybe if I use this as a balance, I can stay with those names, the VRTs, the NVIDIAs longer by having that type of balance. So food for thought. I'll try to find that podcast. But this looks pretty weak. Does not look like it's acting all that well, obviously. What else is big? Let's look at NVIDIA. I guess we'll go to next. So it hit my lower trend line alert today. Just so that I don't have to watch it. I like to draw trend lines on these stocks so I don't have to watch them all the time. And I'll get alerted to, I'll be doing something and get alerted to it. So you try to break out of a nothing on the earnings, and so far, if you bought the nothing 480 and used a 5% stop, you probably are stopped. Yeah, 456. Basically hit your stop today. If you bought the breakout through 480-ish or something. If you bought it here or here or here or here or here or here or here, you can leave it be. The jury's still out. I think I know it's the leader of this bull market we're in. And so if the bull market is over, then this is going to tell the tale. This is why it's in the last few days I've noticed the weakness in NVIDIA. So there was a day here, I think, where it opened higher for half a moment and then was down. And then maybe it was this day where it opened higher and then was down, or somewhere in there. But it just felt like it kept open. Twice it opened at like 498, 499, something just below 500. And 6:30 my time, it's 499, and 6:31 it's 495. And I'm just like, oh, not that I want to take 499, 4 points on a $450 stock, but just like it couldn't hold those gains twice. And so I started lightening up based on that, because that's just what I do. And then the next, I can't remember, one of these days finally it just got me out. So I've moved on from it, but it's top of the list of stocks I watch for sure. It's right on the 50-day. It's tempting, but I feel like I've tempted the stock odds too much with the 50-day, because I've bought it there and I bought it there on that reversal day. And this is the third time in such a short period. I have a feeling this one's not going to work. What does that mean, not going to work? Well, down enough to stop me out, 5%. So stop 5% from 456, another $23, something like that. Puts it at 433 in this area. I would love, of course, because I'm not in it, but I'd love to see it take out 403 and really shake the tree. Something like that would be great. So some type of move, boom, boom, like that. That would be very interesting. But as of now, I'm just an observer of NVIDIA. VRT, sort of the same thing. VRT's kind of been on the tailwinds of NVIDIA because of what they do. Honestly, it's acting way better, at least in the last few days, in the short microcosm observation. It probably didn't need to be sold, but I did sell it because I didn't like the action in NVIDIA, and I was afraid they were going to start looking around and sell that one. And so I am out of it, and it feels weird. I hate being out of it because it's been so good to me. It's been my best stock this year on the long side, but I have to honor my system. My system tells me that it should be sold, and I might, if it trends higher, I might miss it, but eventually it's got to build a base, right? If it's going to 100 or 200 or 300, look at that monthly chart. There's got to be a base in here somewhere, right? I'm really looking forward to a base. Let's look at Celsius, CELH. So this is one of the better leaders for sure, right up there with NVIDIA, that I don't own. I don't like the drinks, and that influenced me. That was kind of silly of me. I should have just used the chart. Like, look at these earnings and sales. So, huge earnings right there. 344%, 95%, just like Li Auto, right? What do I know about Chinese stocks? But those types of numbers are jumping out at me. And I probably should have bought it like there one of these times. and then it came down to the 50-day. I don't know how you're supposed to do that into earnings. If you have a big cushion, you believe in the system, I think you just take a chance and own it. But then when it gaps up, I'm not going to buy it that day, but I'm going to watch it. And this is my favorite type of action right there. That's a day in hindsight should be bought. So the stock breaks bad. It's down 5% and change that day. And what's the low that day? 169.12. And the very next day, the low is 167.16. So it tried to go lower for a couple of dollars and couldn't. So it can't even go down for more than 1 or 2 days. So that reminds me very, very much like VRT. I think that's how I bought VRT back, something like that. Yeah, exactly. Right there, like that. So it goes down, tries to go up. It closes on the low. It's supposed to go down. It does. It went down, but then an hour into the day, it's blue. And so that's really positive action when you see those kind of tails. So that's there. And then now, if you own it, you just sit back and enjoy the rise, doing absolutely nothing. It's probably the best stock in the market because it's much, what is it? Inches off of all-time high, whereas Nvidia is a little bit less. But this has been a good one, and I've missed it. Something to study. Like, why did I miss it? Well, I know why I missed it. I don't like the product. Okay, well, how can I fix that? Well, 10 billion other people like the product, Scott. How do you know? Well, the earnings and sales are so huge. Simple. Sometimes the game can be that easy. Let's look at Tidewater. So Tidewater to me is the leader in the oil and gas area. It's definitely the leader in field services, but I think in the whole oil and gas thing, I don't know, this is my favorite. Big earnings and sales. It's not that big. Look at the market cap. So it can move when you can make some money versus Chevron or Exxon. It's not totally illiquid, but it's small. But yeah, this one's acting really, really well. Splunk, this is a name that's kind of new that I haven't done too much with in a while. So it breaks out of this double bottom. Earnings up 689% in 1 quarter. Look at that, 71 cents versus 9. It's pretty impressive. Revenue is not all that great, 14%. The margins are really high, but revenue is a little pedestrian, but the stock is acting pretty well, or very well in the short term, I should say. And then last but not least is Lilly. It's funny that I think in this area, 5 was when I was buying Novo, NVO, 529. Let's see if I got that right. No, I was buying Novo, I think here, and got out here, and then tried again there, and I wasn't in it when it gapped up. And the whole time I was like, I liked Novo because the earnings and sales looked better. 19, 38, 53, 18, 24, 37, accelerating. But I knew, and I think I said it out loud a number of times, that Lilly was acting better technically. The stock was acting better technically. And I should have bought Lilly. Another lesson learned. And this is just in beast mode. Now, this is a really big company. It looks very extended. Like if you're long this, and you're above like this upper channel line, like that. If I draw it like that, you're kind of above it as well. It looks like a trim, probably. I would be a trimmer for sure, but I don't own it. So it's easy to say what I would do if I owned it. But I think it looks like a trim here. Reduce your position and then look to, go back to full position when it tests the 50-day. Because it will, like, here you probably thought, oh, it'll never go back down, and then boom, 434, and you're sitting there with liquidity to be a buyer. But what a great stock. Another lesson for this year. This one is Lilly, another one to study. I think that's it for stocks to watch. Okay, let's jump to the quote of the week. Kevin Muir, he has a podcast and he was a guest on a podcast. He said, one of the things I tell retail investors, their biggest advantage is that they're not going to get fired by underperforming. I talked about those performance numbers previously. They are able to sit through the pain of watching the stock market go up more than they're going up. So this is very, very important. I've been running my own money for a long, long time, and you should never try to beat the market every week, every month, every year as like a be all end all. Of course, that's probably your goal, but it's okay if the S&P does 30 and you do 22, because maybe the next year the S&P does 3 and you do 22, or the next year the S&P goes down and you do 8%. Or something like that. Or in COVID, the S&P goes up. I don't know what the S&P went up in COVID. I could probably pull it up. I have all the numbers. I track them. Let's say it went up 30% in the COVID year. Well, I went up 100%. So I have 3 years. If the S&P did 30, 30, 30, and I did 100, 0, 0, I'm basically the same as the, so it's those key years that are really important. The key years when the market's really good, hopefully you do a lot better than the market. And when the market's really bad, you should do a lot better than the market by not losing as much. And then the other years, there's going to be some noise. Maybe you miss NVIDIA or you miss CellH. I'm underperforming the S&P this year for sure. Or maybe I'm underperforming the NASDAQ, and me and the S&P are very close. I think it depends on where the S&P is up. I'm up like a teenager this year in my IRAs. So the main thing is I don't have any fear that I'm going to fire myself. There's been some years I probably should have fired myself for some of the trades that I did, but I don't have to worry about that. It's a big advantage that you have versus, because so everybody who runs money, and I've run money for other people at William O'Neill and Company, and as a capital company, and as a traditional stockbroker, it's hard. It's a lot harder. It's different. You have market risk and you have career risk. So you have the fear that the risk that you do 20, but the market does 50. And Mr. Jones says, what do I need you for? Well, Mr. Jones, maybe the market does negative next year and I protect you. That's what you need me for. But at that very moment in time, he's not thinking about that. He's thinking about the money left on the table. And so you have career risk. They can take the money, pull the money from you when that happens. Just a single year, they might lose patience. So it's very difficult, which is why you get these types of moves in these big stocks, I think, sometimes, because a lot of hedge funds and mutual funds and et cetera, that career risk is huge. Imagine you being a mutual fund manager, how much pressure you're under to perform. And the funny thing is I think the stats will show you very, very few of them beat the market. I should have pulled that number. I was shocked at the number of mutual funds that have beat the market in the last 15 years. It's almost none. It's ridiculously low. So I don't know why they have this fear of trying to beat the market, because they never seem to be able to. So, but yeah, that career risk is real, and so that puts a lot of pressure on you. So if you're running your own money and you're doing some of those numbers like I showed you, you're doing really well. Keep it up, and hopefully the power of compounding will be on your side. I mentioned the meetup that Charles Harris did last Saturday. It was a live event. I don't know anything about the recording, so hopefully it'll find its way into the metaverse and you'll be able to find it. I know a couple of people have asked me about it via email and on IB Live. It was on a webinar. It was on a meetup. It was live. I watched as much as I could. I didn't watch all of it. I do hope they record it, and I do hope they release it, because I would like to watch it again. Where am I going with this? But he talked about performance and running your own money, and he also talked a lot about taxes too, and the fact why when you're trying to compound your wealth, to have like a tax deferred account like a Roth or SEP or pension or all of the above. I have, oh gosh, I must have between me and my wife 8 or 9 different tax deferred type accounts. I have tax deferred accounts for my kids, Coverdale's. So I understand it's a lot harder when you have taxes and then, living expenses. So, I was talking to a friend of mine. I'm gonna go off a tiny tangent, but if you turn 0 into $1 million, let's say you go up tenfold, or you turn 100,000 into 1 million, and you go up tenfold. Well, the government, if you live in California, about half of that's gonna go away, because you're gonna owe about 40 in federal and about 10 in California, give or take, right? So now you pay 450,000 in taxes, right? You made 900, and so now you have what's that, 550 left? You 1 million down to 550. And then let's say you have a tough year, you go down 15%. So the next year you go down 15%. So now you have 550 minus 82, and now you have 468. And so just 2 years ago you had $1 million, and now you're looking at 468, and mentally it's like, gosh, that feels terrible. And if you're trading for a living, which seems to be everybody's dream to trade for a living, let me tell you, I did it for a long, long time. It's both good and bad. It's not that glamorous. There's a lot of pressure on you. But let's say you're trading for a living, like I was. All my living expenses were paid by taking it from the market. This is the first job I've ever had. I was a stockbroker, but I was not a good stockbroker. I was not that I was doing poorly for clients, but I was too interested in trading my own money. So I didn't have a very big book. So I didn't make hardly any money as a stockbroker. That's the story. But let's say that 468, and then I had 120,000 in, or let's say I had 60,000 in expenses each year. So 468 down to 348. And this is stuff that happened to me. And it's like, where did all the money go? And then now you start putting pressure on yourself to get it back, right? Because you're in a hole. And what you should do when you're in a hole is stop digging. But instead it's like, oh, I got to get back to 1 million. I got to get back to 1 million. And then you do something stupid and you turn the 350 into 250. So he talked a little bit about that, and I thought it was very interesting. So hopefully they will release that somewhere, maybe on the internet or something, on Twitter, and you'll be able to see that. So, okay, I apologize. I went off on a tangent, but it just occurred to me. A lot of people were asking me about the Charles Harris thing. I love to listen to Charles. I relate very much to his stories. Next week, in fact, I'm not going to give it away, but next week I'll one of my favorite sayings in all the market comes from Charles Harris, and you're going to have to watch next week to see it, or to hear it as well. Okay, Marcus Smith at investors.com, 800-424-9033. Thank you, everybody. Have a great weekend. We will see you next week. Bye-bye.